Welcome everyone, this is Stuart Weems, Director of ProSolution Private Clients. So thanks again, and sorry for the late start, just had a couple of technology hiccups. Technology is supposed to help us, not hinder us, but it doesn't always do that, I guess. Joining me tonight is Jerry Muralatis, Senior Financial Planner. Good evening, Jerry.
Hello all.
I nearly said good morning. We've got plenty of time for questions tonight, so as we go through the presentation, just type out your questions in the question box, so you should be able to see that. If you don't actually see the question box, which should be in the top right-hand corner of your screen, there might be a little red arrow that you need to click and that'll pop out and the question box will be there. So as we go through the presentation, ask whatever questions you like, and Jerry will answer all the hard ones at the end of the presentation tonight.
Thanks, Stuart.
We'll go through, we've got about half an hour or so of 30 to 40 minutes of presentation, if you like, so we've left plenty of time for questions at the end, and we've got a bunch of them to answer, so keep them coming through. Obviously, which I'm going to talk about the budget in a second, but obviously superannuation has become even more important, I think, to manage well, given that the government has just increased the compulsory superannuation contributions from 9% of someone's salary to 12%. Obviously, that's staggered over a number of years, but lots of money is flowing into the super system, and now even more will do so. Self-managed super funds are actually the biggest sector of superannuation.
And the fastest growing.
And the fastest growing, correct. So tonight, what we'll do is we'll go through a bit of a super update. So I want to talk a little bit mostly about the budget changes that were released on Tuesday. Jerry's then going to take us through sort of 5 common mistakes, some age-based strategies and some contribution strategies. And then I'm going to talk a few about some case studies, well, they're kind of strategy studies, if you like. And as I said, we've left about sort of 20 to 15 minutes of time at the end to answer your questions. So as we go through the presentation, we obviously can't necessarily stop and answer your questions then, but we'll certainly come back to them at the end. So let's jump into it. Okay, so obviously on Tuesday night we just went through the federal budget, and there was a little bit of interesting stuff in that. Probably the major change is to the taxation of contributions for anyone that earns over $300,000 a year. So up until now, regardless of what you earned, any superannuation contributions, concessional superannuation contributions, were taxed at 15% as opposed to your marginal tax rate. So people on the highest marginal tax rate, those earning more than $180,000 a year, instead of paying 46.5%, in your personal name, you'd only pay 15% in super. So obviously contributing to super was a really good strategy. Now, for people, what they've proposed in the budget, obviously for people earning over $300,000, their contributions will be taxed at 30%. So still a benefit, but obviously the benefit is reduced. And the way they pitch that is the rich shouldn't get as high a sort of tax breaks, if you like, compared to people that earn less income. So what do you need to do? Well, obviously if you're on the precipice of that $300,000 mark, obviously you need to think about some strategy of whether they're worthwhile to potentially pull your income below, taxable income below that $300,000 mark. If you're well above the $300,000 mark in terms of earnings and taxable income, well, there's probably not a whole lot that you can do. Superannuation contributions are still tax effective, so I wouldn't imagine that's really going to change your strategy that much, other than obviously just pay a little bit more tax. One of the other major changes they announced was that what was supposed to happen from 1 July this year, that anyone that had a superannuation balance of less than $500,000 and was aged less than 50 years old, instead of being limited to making $25,000 a year of concessional contributions, and remember, concessional contributions are before tax contributions, that they were going to double that limit for those people and allow them to make $50,000 worth of contributions. Well, what they've done in the budget, or what they're proposing in the budget, is that they that instead of starting this year, that they'll start in 2 years' time, so 2014, which is a shame because obviously people with lower balances, 500,000 or less, and they're 50, getting closer to retirement, and maybe their balances have been whittled away because of the GFC and the stock market performance, being able to contribute more than 50,000 would have been a really good strategy for them. Another change is they're phasing out pensioner drawdown. So what they did around the GFC, time of GFC, is they allowed people that were on an allocated pension or account-based pension draw less out of their super fund because normally if you're on an allocated pension, you've got a minimum amount and a maximum amount that you can draw each year. Anyway, so what they said during the GFC is we'll let you take out less so that you don't eat away at your balance or force you to sell shares and so forth. So they're getting rid of that now and going back to the normalised minimum and maximums. And look, there was a whole host of kind of non-super stuff. There was some increases in family payments, family benefit tax A and B, maybe arguably a bit of checkbook politics there, I guess, throwing some money around. There was some reduced tax for golden handshakes, so people that got redundancies and so forth. A couple...
Reduced tax offset.
Reduced tax offset,
so more
sorry.
tax.
And for self-employed, for people that are self-employed, probably two really positive ones was the loss carryback, which means that if you, for example, reported $100,000 worth of profit last year and say you paid $30,000 worth of tax, and this year you're going to record a $100,000 loss, what they're saying is that you can actually then claw back last year's tax, so you get a $30,000 refund from the ATO. That's quite positive. Well, obviously it's not positive if you're recording a loss. And the other thing was equipment write-off. So you get an immediate tax deduction for any equipment that costs $6,500 or less. At the moment, I think it's only $500 that you get that write-off. So that's very good too. And they've reduced the 50% discount for interest income, which they announced at the previous budget, so it wasn't a very big deal. I'm going to talk about some superannuation legislation changes around property and borrowing to invest in property later in the presentation. But what I thought, just to sort of increase the level of interaction, is I'll launch a poll before I hand over to Jerry. He's going to take us through the 5 common mistakes. And so the poll will come up, and essentially what we're asking is, what does your self-managed super fund currently invest in? And you can tick more than obviously one answer. So if you're invested in shares and property, just tick both of them. And obviously cash, lots of super funds hold lots of cash, but if you hold more than, say, $50,000, so material amounts of cash. Just kind of interesting to see what we're all invested in. So I'll just give you a couple more seconds to complete the answer. I'll close the poll then and share the answers with you. So it's a couple more seconds. Okay. Looks like we've got most of the results, so I'll just close the poll and share the results with you so you can see them. Okay, so it looks like, well, interesting, 60% cash, 60% direct shares, managed funds, and no direct property. Well, that's interesting. In fact, the statistics here, because the ATO released statistics around where, on the whole, self-managed super fund is invested, so there's about $400 billion invested in self-managed super. And they released some statistics, and actually what our poll here doesn't really differ very much from what the statistics show us. So that's kind of interesting. Well, I'm going to hand over to Jerry now, and he can take us through some mistakes.
Thanks, Stuart. So let's have a look at the first one, and it's a very common one. That's having too much money in cash. And over the years, ASIC has raised concerns over this particular issue several times. Typically the way it happens, and I've seen it over the years with a lot of clients, busy self-employed individuals and professionals who I guess have a tax problem. The accountant says, why don't you put some money into superannuation, set up a self-managed super fund, make a large contribution, and then really do nothing and think about it again in June the following year. I guess in terms of holding cash, the polls indicated that there's about 60% in cash, and that is broadly representative. I guess in a post-GFC environment, arguably that's justifiable, but I'd hazard that that's not a strategy for the long term. If you think about it in terms of risk versus other investments, I would argue that in the long term, a term deposit is probably the riskiest investment because you've got a 100% chance of running out of capital because it doesn't provide you with growth. Well, unless you're fortunate enough to have maybe $20 million in your super fund. But the point is having a term deposit or having all your money in cash isn't a risk-free strategy. And as I believe everyone tonight has a self-managed super fund, you'd be aware that you need to have an investment strategy for your super fund, and the investment strategy needs to have regard for things like risk, return and liquidity. So you've got an obligation as a trustee of the fund to provide, I guess, the best possible return that you can for members. And just recently I read an interesting article that postulated, I guess, the potential for self-managed super fund members to sue trustees, and the logic there is arguably that they'd be suing themselves. But anyway, so the logic went that they would sue trustees, sue the trustees of the fund who are responsible for the investment strategy if the fund's returns were undiversified, for example, in one property investment, and therefore they could show that the return was less than you would get from an index fund manager as a benchmark. I don't know how much water that argument holds, but it is an interesting one, and I suspect, over the years we will see litigation about responsible investment of super fund assets, and I expect that ASIC would become more vocal in this space as well. So the next one is inappropriate risk. And to talk about this, what I'd like to do is take a step back and just talk a little bit about what is risk. So, investment 101, I guess, risk is the uncertainty of returns or the variability of returns. So we talk about a risk premium. The more risky an investment is, the more uncertain its return is, the higher the premium you should expect in terms of your return, whether that's in the form of income or capital growth, or both, in fact, depending on the investment. So something like a term deposit, cash, there's no risk, low premium. There's no premium for cash. Things like bonds have a higher level of risk, so you'd expect a higher level of return. And things like investment grade, or what we'd consider investment grade property, negatively geared for several years, should experience good capital growth, more a capital growth, but I guess a higher risk associated with it. So higher growth investments, higher risk associated. I think as a member of a super fund, and certainly as a trustee charged with the responsibility of investing for the fund, you need to understand that, and you need to understand, I guess, a couple of things in terms of the risks that you're undertaking. Things like your time frame. So we'll touch on this point. There's some common recurring themes, but we'll touch on this point again in a moment. But what is the time frame of the members of the fund? How long do they have to invest? When are they going to need access to the money? I guess what's your risk profile or the risk appetite of the members of the fund? And I think about this as the sleep test. As advisors, as professionals in the industry, we see a lot of different investments, and they have different merits. And often clients ask, "What do you think about this investment?" or "What do you think about that investment?" I think ultimately you need to feel comfortable with the investment. And I think it also involves you having a level of understanding about it. Now, some investments are really complex, and I don't suggest that if you're going to invest in anything, you should understand it perfectly, but you should understand the basics. If you don't understand the basics, if it doesn't make sense, don't invest in it, would be my advice. Now, the other thing to consider too is that the difference between market risk and investment manager risk. So probably the best way I can exemplify this is if you think about the difference between an active fund and a passive share fund. The passive share fund invests in the market, so something like an index fund would invest in the market, and it's not risk-free. The market goes up, the fund is exposed. The market goes down, the fund suffers. In the case of an actively managed fund, however, you still have that market risk, but you also have the risk of the investment manager making incorrect decisions. So incorrect decisions about which stocks to buy and sell and when to buy and sell those investments. So as a trustee of a superannuation fund, as a member of a superannuation fund, you need to have regard for these things. There's no one answer, unfortunately. I can't say to you, invest in this, don't invest in that, but as a guideline, if you stick to those sorts of things, understand at least at a basic level, and the better you understand it, the more comfortable you'll be with it. And probably a final note on that is just about, I guess, traditional portfolio asset allocation theory, which is, holding a diversified portfolio of funds. That certainly holds true and it's sound. However, my one proviso to that would be I'd feel more comfortable with clients having an asset allocation that they understand and is appropriate for them, importantly, rather than one that's very well diversified, maybe a lot of shares, for example, but you don't understand it, you're not comfortable with it, because you're far less likely to stick with it for the long term. So that leads us on to the next point, which is a poor investment strategy, and in fact, in some cases, no investment strategy. And I mentioned earlier that as super fund trustees, you need to have an investment strategy, and it needs to have regard to a number of things. An example is purchasing a property just before retirement. So, self-managed super funds, we've said, are becoming increasingly more popular. And in fact, the property inside the super fund strategy is becoming very, very increasingly popular as well. But I think there's a right time. There's definitely a wrong time for various strategies, and this is a classic one. Arguably, approaching retirement, you need more liquidity to pay pensions in the funds, and purchasing a property, or what we'd call an investment grade property, won't necessarily give you that liquidity for a number of years. If you've got other cash or other assets in the super fund, it's not so bad. But going out with one large asset that takes up all the money or the cash of the fund is a really poor investment strategy. Another example is coins and collectibles, and quite frankly, it's a reason why some people go into superannuation, that they can have control over their investments, but beyond that, they sort of lose the investment fundamentals and say, well, I love art, I know a little bit about art, or I collect coins, and I'd like to have those through my superannuation fund. It's quite tempting. I'd exercise caution in relation to that. Even if you're an astute collector, there are restrictions on that. You need to observe those. For example, you can't have the art hanging in your home. I can hear some of you thinking, how will they know? But there are other restrictions as well, and generally in terms of getting the best return for the super fund, I wouldn't subscribe to that as an investment strategy. Back on property, another one is investing in property on the coast or somewhere in the country. For a whole host of reasons, that's wrong. It often has a lot of appeal because people think about, well, I'll buy something in the country or I'll buy something on the coast and it'll be my super fund, and then I can live in it in retirement. Again, there's restrictions around that, but also blending what's an investment versus what's a lifestyle asset, potentially very hazardous from a compliance point of view, but also from the growth that you're going to get from your superannuation fund. Trading is another one. Trading stocks, trading a whole range of things. I would suggest that if you're looking at trading shares, regardless of whether it's in a super fund or outside some other structure, you need to appreciate that you need both time and expertise. It's almost a business. I know some people, and we have got a couple of clients that do it, without any offence to anyone who might be listening, but I don't think there's anyone here actually listening who's in that situation, but I kind of think of them as highly energetic, almost ADHD people that that get about 3 or 4 hours sleep a night, and so it's something that helps ease their tension. Look, if you like it, think about it as a hobby. Don't invest large sums of money or hope to make large sums of money from trading. I know that might sound a little bit self-serving, but Look, another really good example is trading derivatives, so things like options and futures. And, you know, I've seen a lot of examples over the years of people who should know better and people who know that they know better. Strictly speaking, you can trade options, for example, in a super fund. There's additional compliance that goes with that. So you need to have, for example, a derivatives management statement. But typically these types of investments, I guess, accentuate or magnify both the gains and the losses. They have special risks. You know, sometimes you stick to a strategy, you've gone to a course, and then, you know, the strategy starts to go a little bit astray and you've got to try and cut your losses or, you know, cover your calls or whatever the case may be. So, again, I'd caution about these types of investment strategies. So the other one is about gearing in superannuation and having too much gearing in super. I guess the thing to appreciate is that gearing overall is less effective in superannuation and self-managed super funds, and that's because of the lower tax rate environment in super, and certainly, especially so in retirement, it's tax-free. The main advice there would be to self-regulate and get good advice. Typically, if we're talking about, say, purchasing a property inside a self-managed super fund, and we'll go through a worked example later on, but that strategy would require some reliance on contribution. So it would rely on the rental income from that property, but for a period of time it would also rely on your contributions. And typically because of the limitations on how much you can contribute into a super fund or how much you can contribute concessionally into a super fund, you don't want to get caught short. So we talk about having a cash buffer, and again the worked example that we go through will give you a better indication of that. But having a cash buffer for liquidity, but also to cover property expenses. You know, properties might require repairs, some maintenance, to be able to service those without necessarily having to make additional contributions. The other thing I will say, look, we do a fair bit of bank bashing actually. Would you agree, Stu?
Yeah, definitely. Whenever we get a chance.
But on this occasion, I'd say, you know, that the banks are actually getting better at regulating. If we're talking about gearing outside superannuation, we do a serviceability calculation for a client, and the bank would say, for example, you could borrow $2 million. We'd run our own figures internally of what the prudent level of gearing, prudent level of borrowing. And, you know, we'd say to that client, well, you know, you should borrow 1.2, you shouldn't borrow more than that. In the case of self-managed super funds over the last couple of years, the banks have actually become more restrictive, and I suspect in part that's trying to preserve the industry because of heightened concerns from the government around the security of superannuations, particularly since I guess the inadvertent almost ability when the laws changed in 2007 to allow you to borrow inside a superannuation fund. So I'd have to say they're getting better at self-regulating or regulating clients so you don't borrow too much. We'll talk in a little while about what an appropriate level of gearing is inside a super fund, but that's certainly one to be aware of. Now this one's going to be a little bit controversial, but investing in a managed fund or investing in managed funds. And I noticed in the poll earlier that several of you have managed funds. The point here is what I really object to is the poor advisor that sees a client with $50,000 or $100,000 and sees an opportunity to get an advice fee and maybe some, the accountant's going to do the compliance on the fund and earn some money there, and says, look, take your money out of the industry fund, take your money out of the corporate fund, and set up a self-managed super fund. Realistically, if you've got $50,000 or $100,000 in a self-managed super fund, one, there's probably not enough scale there to make it cost-effective. Having that money just sitting in managed funds, you could do it. There's nothing wrong with managed funds, don't get me wrong, but you could probably, I'm sure you could do it a lot more cost-effectively outside the super fund, the self-managed super fund arrange it. So just get a wrap platform type service. Having said that, control of your investments is not the only reason why you'd have a self-managed super fund. So things like, control of your contributions, and we'll talk about contribution strategies in a moment. Control of your insurance proceeds. So if there's a whole range of reasons that mount up to make a good argument for running a self-managed super fund, and you just don't quite have enough yet to purchase property, if that's what you'd like to do, then direct shares is one option. Maybe managed funds is another alternative. So as part of the bigger picture, it's okay, but just the caution that if that's all you're doing, you're probably not maximising your super fund. Just a reminder to keep your questions coming through too. We've got a list of questions to address, but if any come up along the way, just type your questions through to us, and we'll try and get to as many as we can. And I think what we might do now is go to another poll. Stuart.
So this question is, does your contribution strategy extend beyond non-concessional, that should be extend beyond concessional contributions. Sorry, the question says non-concessional there. So that means, have you thought about contributing more into your super fund other than what your tax-deductible contributions are? Sorry for the confusion there. So either click yes, no, and if you have no idea what I'm talking about, just click don't know. So we'll give you a couple more seconds there, and then I'll close the poll and I'll be able to sort of share the results with you. And the next section that Jerry's going to take us through will probably tell you a little bit more about the reasoning behind the question. So I'm going to close the poll, and I'm going to share the results. Oops, click that one, share the results. So 67% say no and 33% say yes. And not everyone voted, so I think I probably ended up confusing a few people. But that's okay. Jerry can unconfuse people.
I'll try. Thanks, Stuart. So contribution strategies. Well, I might start with the question of when do you start? How early do you start? So, I love superannuation, but also hate it. And if you've heard me speaking before, you've probably heard me say that. And I think I've blogged over the last couple of weeks, and that sort of comes out as well. But I guess what I love about it is that, it's a good way and a good, safe way to build wealth for the long term, for the future. And it's tax effective. What I don't like about it is that the governments and successive governments keep changing the rules, and I guess not providing a lot of certainty for people as they approach retirement. And the fact that you don't have access to it takes a lot of the gloss away. Don't get me wrong, there's huge, tremendous benefits in having a super fund, whether it's a self-managed super or just saving through another superannuation vehicle. But I think it's well worth considering when to launch that, or to launch it in a bigger way. So if you're making a lot of contributions, if you're thinking about maximising your caps, but then also possibly non-concessional contributions, I think arguably their strategies, or certainly the latter, is one to consider closer to retirement. And I say that because, if you're 50 now, I'd like to think that you should be able to access your superannuation at age 60. Let's face it, it's 10 years away, and with that sort of time frame, for the government not to give you that sort of certainty and peace of mind would be really unfortunate. But if you're 40 at the moment, you're 20 years away, well, I think, opinion differs depending who you talk to. But I don't have great confidence, and I'm a little over 40, not that much, but I don't have great confidence, for example, that I'll be able to access my super at age 60. I might have to wait a little bit longer. So then we need to think about, multiple, I guess, retirement strategies. One would be super, and one would be money that we can access earlier than that. But definitely concessional contributions, there's a tax benefit there. As we said, for higher income earners, it's about to reduce going forward, which is unfortunate, but there are still benefits in doing that. Maximise your limits, and certainly maximise your limits this year before the changes occur. One of the great benefits of, I think, of a self-managed super fund is the ability to deal with excess contributions. So, unfortunately, we're all busy, and some individuals have employer superannuation going in as well as their own contributions, and it's not uncommon to get to the end of the year and you've exceeded your cap. the great thing about a self-managed super fund is that you can reallocate, within reason, you can reallocate those monies inside the super fund. So for example, you can reallocate an excess concessional contribution to a non-concessional contribution and not have to pay the penalty tax. You can allocate it to another member of the fund, or in fact you can allocate it to the next year and allocate it to yourself to the next year. So therein, I just want to point out a strategy that occurred to us as a result of the budget last year. The budget on Tuesday. So as it stands now, if you exceed $300,000 in adjusted taxable income, you can effectively, if you contribute next year, you will have half the tax concession, half the benefit. You can effectively contribute double your cap this year, get your deduction at the 30% rate, and then within your super fund, and I caution you do need to have a self-managed super fund to do this, then you can reallocate the other half of the contribution. So if your cap is $25,000, put in $50,000 this year, and then you reallocate it next year. But you need to make sure that you don't breach your cap next year, and then you can't contribute next year. So I don't know if that makes sense. So put it in this year, get the higher tax deduction if you like, and you've got 2 years worth of contributions in there. The other one is non-concessional contributions, and I guess approaching retirement, it does make a lot of sense. No, you don't get any tax benefits for doing it, but once you put the money in, it's in superannuation, concessionally taxed environment. It can assist sometimes even younger people with the purchase of a property. Some people really like that strategy. We keep referring to it. So if that's what you want to do, maybe a non-concessional contribution can assist you with that. But also other contributions in terms of your strategy. So things like spouse contributions and splitting contributions, but also wherever possible, using the government co-contribution if you've got a low-income earning spouse or someone that you can take advantage of that with. In fact, just on spouse contributions, I might mention another thing that we've done with a number of our clients are doing, and that is if someone's self-employed and they might be a small business owner or they might be a medical profession, for example, and perhaps their spouse is doing some part-time admin work for them or some bookkeeping. The income splitting benefit is nominal because the amount of income that you pay them has to be reasonable, I guess. So you can't pay your husband or wife $150,000 a year for doing 2 hours of bookkeeping for you a week. At least I believe that's not the case, Stuart. Would you?
No, that's right.
But what you can do, for example, is pay them a nominal and commercial salary for the work that they do for you, and then pay the maximum concessional contribution into super. And if you want the legislation, the reference that allows you to do that, we're happy to send it to you. So that's another strategy that's available there. Other things include, again, for business owners, small business tax concessions. So on the sale of what's called an active asset from a business, you can put some of the money into superannuation and save some capital gains on the sale of that business asset. Another really interesting one is having a couple of self-managed super funds, and we have a couple of clients in that situation. So where you'd split, for example, your non-concessional or after-tax or tax-free super from your concessional super contributions. And look, there's a couple of reasons why you'd want to do that. I can hear the technical ones amongst you going, well, what's the benefit of that? When you turn 60, it's all tax-free anyway, so it doesn't matter. Yes, that is correct, but between 55 and 60, if you've got access to super, potentially there's some benefit there. And also remember my scepticism about the government's, successive governments actually, preponderance to changing the rules. And the other one, of course, is transition to retirement. And that might be appropriate for some individuals as well, and it can be quite tax effective to I guess, change the nature, either get more into super if you haven't had the capacity to contribute, or change the nature of the money to more tax effective without going into too much detail. So what I might do is hand over to Stuart and we'll have a look at those much promised work scenarios.
Thanks, Jerry. I guess what we'll try to do is, instead of pulling out case studies per se, which, and the problem with looking at case studies is quite often a superannuation strategy will be quite heavily linked into a personal investment strategy as well. So while we might be doing certain things in superannuation and we just look at superannuation alone as an isolated case, might not make a whole lot of sense. So instead what we did is thought, well, if you've got a self-managed super fund and you've got some money in to invest, what are some of the things that we're seeing that are working really well? And I guess one of the reluctancies, I guess, to invest in the stock market at the moment is who knows what's going to happen. And certainly there's been lots of volatility this week. I think the stock market was up today, but yesterday it was down nearly 2%. So lots of volatility, and we're wondering where is it going to go and what's going to happen to Greece and probably the rest of Western Europe, really. And so what we're seeing is people investing, it's been quite rare, people investing for yields rather than capital growth. So let's assume that the stock market actually doesn't do anything for the next year, so there's no change in share prices, so capital growth. What can we invest in? And the average, it's interesting, the average dividend yield from, say, 5 companies like Telstra and the top 4 banks, so that's Westpac, NAB, Commonwealth Bank and ANZ, the average dividend yield is 6.8%. So that is, we can go and buy those stocks and we're at least going to get some dividend revenue equal to 6.8%, which is a pretty good return given what the stock market's done over the last couple of years. Now, obviously, that's not risk-free. You know, those companies could run into some trouble that would hamper their profits, but we've all seen what the banks have been doing with interest rates and holding back the RBA movement, so I don't think their profits are in any risk at this point. And perhaps maybe the best strategy, instead of getting angry with the banks about them perhaps taking advantage of their situation, competitive situation, is to invest in them and take some benefit there. The other benefit, obviously, with the self-managed super fund is that you can invest in the shares that you choose and you don't necessarily have to suffer any transactional costs. So that is, if you decide not to buy and sell shares, that means you don't necessarily need to pay for brokerage or capital gains tax as the result of buying and selling shares, which a fund manager will do. And I think that's one of the benefits, is that you can make long-term investment decisions and stick with them, and they're not going to have negative cost consequences. So put that all together, one strategy might be to invest in high-yielding stocks, still blue chip stocks with good fundamentals. And as I've shown here in the slide, it ends up producing an after-tax return of 7.6%. Now, I don't know about you, but that to me sounds pretty good. The 2 key risks with that return is, as I've already addressed, will corporate profits reduce in those companies? Well, again, if we're talking about Telstra and the top 4 banks, I'd assess the risk is relatively low, but lots of things can happen. And the other risk is some capital growth, which will obviously force the yield down, so that's the share price going up. Well, that's not necessarily such a bad thing. It just means you're going to get less income return and more capital growth return. So it's a pretty good strategy, and it's essentially utilising the key advantages the self-managed super fund gives you over other investment assets, which is you can hold direct shares. You don't necessarily have to buy and sell those shares. You can keep a low cost base. Plus, also you benefit from dividend imputation, which means that the corporate profits are taxed at 30%. But the super fund tax rate is 15%, so you end up getting kind of 15% rebate, if you like, of tax against the dividend income. So that's why the after-tax return is higher than the pre-tax dividend. So that's a very good strategy to consider, particularly if you've got extra cash in your super fund and you're a little bit concerned about where the stock market's going to go. As Jerry already touched on, probably one of the most popular strategies that we're seeing, and certainly has some great fundamentals, is investing in direct property instead of actually going into the stock market. So again, this is going to appeal to obviously people that are more comfortable with direct property, but I guess also for people that have self-managed super funds that might want a level of diversification. So might already have some share investments and want something to complement that. So what I've done on the slide here is showing you how that might work in terms of how much deposit you might contribute to something like that. So in this situation, we've got a rollover or an amount of superannuation to invest of $230,000. So that might be, extra cash that you've got at the moment in your super fund. And in this situation, we would say go and borrow the full cost of the property, or 80%, the maximum amount. So you get a loan of $400,000, and essentially after all the costs, paying for the property, $510,000, stamp duty and so forth, you'll end up left over with about $74,000 of cash, which gives you still a nice healthy buffer of cash, which is really important. In terms of cash flow, obviously you get the rent from the property itself, and you'll still be contributing or making some contributions. And obviously you have some expenses, property expenses, obviously insurance, property management, and those sorts of things, and the tax and so forth. So this shows that that this strategy is relying on contributions of at least $8,000 a year. And as Jerry pointed out, what you want to do is really think very carefully about how much you commit the fund to being reliant upon your contributions, because you might get in a situation where you don't want to make additional contributions in certain years for whatever reason. And so you need to think about that. But that's also the other reason why we like to see a healthy cash buffer, because if we decide not to make contributions in 1 year, or we have vacancies and so forth, we know we're pretty comfortable there. One of the concerns with this strategy is in the Cooper review that occurred about 2 years ago, which was a financial services review. They advised the government to review borrowing within self-managed super in 3 years' time. And they said that there was no signs that it was being misused at this point in time, but to review it in a few years' time. The other concern is that the government's going to change the legislation. It's before Parliament at the moment, so that a self-managed super fund will be treated as a financial product. And that means that anyone that gives advice in regards to a self-managed super fund must be a licensed financial advisor. Up until now, there was an accountant's exemption, which means accountants could give advice and advise you to set one up and advise how to use one and those sorts of things. Well, that's going to change as proposed if the legislation gets royal assent, of course. And so that might actually make implementing this strategy a little bit more difficult, because you'll have to go and find someone that knows property, has a good property expertise, has a financial services license, also has an Australian credit license, so can give you advice around the credit side of the product. And that's pretty rare. Obviously, that almost describes ProSolution, which is great for us. But in terms of advising you and what might happen in the future, the doors might end up closing on this gearing in property scenario. So there might only be a window of opportunity over the next year or so. Who knows what the government's going to do through their changes and so forth. Probably one thing, before we jump into some questions, one additional thing to point out was that because the legislation is relatively new, that is, it was introduced in 2007, there has been a lot of sort of conjecture or discussion around how the legislation is being applied. And there's probably only two issues that we've got at the moment. The first one is there's some restrictions if you go and invest in property over what is a repair versus an improvement. And so you can borrow to fund a repair, but you cannot borrow to fund an improvement in a property. The key thing there, or the key thing we like to see, is buy a property obviously in good repair, so that you're not expecting to make any material repairs, and have a healthy cash flow buffer, and don't overextend your contributions, and that'll greatly reduce your risk there. The other thing is something called a separately acquirable, single acquirable asset. And this is an issue when you go and buy an apartment that often has a car park attached, and the car park will generally be, or actually always be, on a separate title. And what they're saying is that if those two titles can be dealt with separately, you've then bought two assets, and the loan structure becomes quite a lot more complex than it needs to be. So certainly if you're going to implement this strategy and you're going to invest in an apartment, you certainly need to get some great advice there, and it's a property by property specific kind of level of advice. So it's something we've just tackled internally as well. But it's a great strategy. It's complex, and you certainly need to get some good quality advice there as well. Okay, so before we get into questions, the last poll, sorry to sort of pepper you with these polls, but what we're asking here is which advisors do you use to help you manage a super fund? So obviously some accountants do all the work, including giving you the advice and the tax returns and so forth. Sometimes you might have a separate advisor advising on the actual investments. A super fund administrator might be someone that's separate to your accountant that does all the tax returns and so forth, and you might also use your accountant, or you might do a lot yourself. Obviously, you'll still need the fund audited and so forth, so that'll be external as well. So I'll give you a couple more seconds to answer that. Obviously, you can tick more than one option there, of course, and then we'll get into a few questions, actually. So I'll give you just a couple more seconds to answer that. And I'm going to close the poll, and I'm going to share the results. And they're probably not that surprising. We've got the accountant doing most of the work, financial advisor and hands-on. And I guess that's not to be unexpected, given that one of the benefits of self-managed super is more control, and you've got more involvement there. So I'll hide that, and we'll get into some questions. And I think we'll start off, Jerry, I think I've got a question for you from Trixie. And she wants to know about the benefits of borrowing buying a property inside super and taking into account the higher loan costs, and what sort of gearing is acceptable inside a super fund. So maybe you can comment on loan costs and gearing.
Yeah, thanks, Stuart, and thanks, Trixie, for that question. Look, it's an interesting one. Yes, there are higher costs associated with borrowing inside a self-managed super fund. But essentially there are higher costs with setting up a self-managed super fund. So cost is an issue I think that you need to consider and be able to justify in terms of your strategy, in terms of how you're going to utilise the fund. I don't think that the higher costs of borrowing inside super are that onerous if you consider the advantages, and certainly gearing is one of those. Not for everyone. So for the right clients, the right scenario, I think it's excellent. In terms of what the right gearing, the right amount of gearing or the ideal amount of gearing, Trixie, look, it depends. Again, it depends on the circumstances. It's a case-by-case scenario. I think Stuart mentioned earlier that the maximum you could borrow for residential property is about 80% with a corporate trustee. I think it's about 63% on commercial property. So, somewhere between there, the sort of high-end ranges. For most of the clients that we're facilitating these transactions for, the gearing is somewhere between sort of 50 at the low end, 60 to 70% probably at the high end. So I hope that gives you just an indication of range. Okay.
Thanks, Jerry. I've just got another question here from Jenny, and Jenny, and she asked, what's a reasonable percentage fee for the management of a self-managed super fund? So it's an interesting question. So how much should I pay for the advice aspect of a self-managed super fund? I think that's the question, because certainly fees associated with a self-managed super fund tend to be split in two parts. So obviously, in terms of managing it, doing the accounts, the audit and the tax return and so forth, you're tend to going to pay about $2,000 a year for something like that for a relatively simple fund, and maybe a little bit more for something that's got a little bit more complexity. If you're looking at in terms of financial advice in respect to how to invest those monies, there's lots of different sort of fee models out there, but I would say generally you're going to pay 1% of the amount under advice. So that is, if you've got $200,000 in your super fund, you might pay $2,000 a year, for example. But it tends to sort of cap out at around about $5,000 a year to give you an idea. So most advisors have a sliding scale there. If you've got property, so if you've got a relatively simple fund such as that invests in direct property and maybe has a little bit of cash, arguably you don't need an advisor every single year to look over that. So, I mean, you certainly don't need to, it's not advisable to ignore the performance of the property, but you don't necessarily need an advisor. But if you've got a large direct share portfolio, for example, unless you're going to dedicate quite a considerable amount of hours of research and review, then I would say you do need some level of advice. So it's horses for courses, and it depends on the complexity of the fund.
Okay, Abaran's got a question, and that is, at what age can you access a pension from the super fund, and what percentage? Thanks, Abaran. That's a really good question. Probably most of you would have heard about the preservation age, which was 55, and gradually, depending on when you were born, phases out to age 60. So I'd say the earliest age at which you can access your super and start a pension is age 55. From age 55, there are certain conditions if you want to access superannuation. And then in terms of the minimums and what percentage you can access, again, it depends a little bit on the type of product, but typically speaking, an allocated pension, the minimum is currently 3%, going to go to about 4%, and depending on whether you're 55 or 60, maximum is either 10% or whatever you want it to be. So the minimums and maximums are quite generous. I think that the government wants to try and make sure that you keep your super in accumulation stage as long as possible, but once you've reached your preservation age, it's quite flexible as to how you draw on your super. So thanks for that question, Abraham.
Okay, the next question is from Wally, and he wants to know, can you invest in overseas real estate? Well, it's interesting. I've actually researched this question before, so luckily I know the answer. You can. You can't borrow to invest in property that's located overseas, but if you've got a lump of cash and you want to, I would imagine, go and invest in US property, which tends to be a popularised strategy, you can certainly do that as long as it's within the super fund's investment strategies and the rules and so forth. There's nothing in legislation that says that you can't do that. I would strongly caution anyone against doing that. To me, I'm a pretty simple guy, but investing in something that no one else wants to buy and potentially no one else wants to buy it or own it for a considerable amount of time doesn't seem to make a whole lot of sense, given good quality investments tend to use the laws of supply and demand in their favour, so that it is you want to always own an asset that's always in excessive demand and restricted supply. So I've got lots of problems with investing in real US-based property. Plus also the big question is, how long will it take the market to turn around? And I guess the bigger question beyond that is, what are you going to miss out on in terms of alternative investment strategies in between that time? So you can do it legally. Do you want to do it? I'd question that. And I think we've got time for one more question, Jerry.
Oh, okay. Let me see, which one shall I choose? There's a lot of good questions. Okay, the differences between, this is an interesting one, the difference between an enduring family super fund as opposed to a self-managed super fund. I first saw references to these enduring family super funds, I think about 18 months ago, and a lot has been said in the industry about them, but the best that I can work out, the take-up hasn't been that fantastic. So I'm not sure whether it's more of a concept or a product, if I can say that. But I guess if the concept of it is that that you have a super fund that has perpetuity and you can add children and other generations. Now, the restriction still does apply that you can't have more than 4 members in the super fund, but the notion is that you can introduce your children into the super fund and have benefits transfer from the older generation into the newer generation. And for wealth transference, there's certainly some benefits in doing that. However, I think, and that's not to say that you can't have your children, by the way, as members of just a normal superannuation fund, if you like. What I would caution is about I guess it's a principle similar to trying to rule from the grave when you're looking at estate planning. And I recall a case where one individual had bequeathed a sum of, I think, $450,000 to each of his children, and the condition was that they make it a contribution, that it be made as a contribution into their respective super funds, and if they didn't, that it would go to his nominated charity. So I think it gets complex, particularly when the family unit grows, I guess, and disperses. So, children in the household have their own families, and then there's in-laws, etc. It could become quite complex, and I don't know that there's huge merit. Great sentiment, but as far as I'm aware, there's as much complexity as there is benefit to it.
Excellent. Well, before you all go, I'll just take a minute to thank you very much for listening in to tonight's session, and actually just let you know, obviously we've got a number of ways in which we can help you, particularly now that we've launched ProSolution Chartered Accountants. So obviously we can take care of, establish and take care of a sovereign super fund. Obviously as fee-for-service independent financial advisors, we can give you advice on, if it's just initial advice on what you should invest in, or ongoing advice depending on the complexity of your fund. And clearly if you're going to invest in property and borrow to do that, we can certainly give you some credit advice on how to structure the loan and which lender to use and those sorts of things. So one or all or combination of those different services, I guess it really starts, as lots of conversations do, by really understanding your needs and guiding you through that process, and probably giving you a bit of guidance about what we think we need to be involved in and what we don't need to be involved in, vice versa. So more than happy to have those conversations. We certainly welcome them. But for tonight, that's it from us. So thank you very much for listening in, and we look forward to talking to you soon. Thanks
very much. Appreciate your time and your questions.